G'day everybody, welcome to another weekly general update on the markets for the 27th of May. We had a bit of a quieter week last week, but nevertheless markets are still pretty well poised and could go either way at this stage. So let's have a good look at the action. First of all, just the important information regarding general advice. So for the S&P, it ended up rising by 23 points on the week, which meant that the key 1290 point level held, but really it was all in one trading session. It was on the Monday, and after that the market really just bobbed up and down and didn't really go anywhere. So not all that convincing, despite the fact that it rose by 23 points. And the other indicators that I look at, both other markets and sentiment indicators, are still not pointing to a disaster at all. It's not to say that we can't have some major event in Europe that might destabilise markets, such as Greece deciding to leave the Eurozone. But certainly the indicators are not pointing that way at the moment. There's still expectations of more stimulus coming through from either the ECB or the Fed, and I think that's part of the reason that a lot of the markets are still relatively stable at this stage. Now, by comparison, our market lost 17 points on the week, which is pretty disappointing, and we continue to underperform, certainly the US market, but to a degree what's happening overseas as well. The selling was across pretty much all sectors, and fears over China are really impacting on our resource stocks as well. I think the resource majors have probably been pummeled down to a pretty low level at this stage, but certainly other stocks in the resource area are starting to look a bit shaky as well. And I think unless there is some accelerated stimulus announced in China, that is probably going to continue for some time. Let's just have a look at the major indices, and we'll start with the S&P. Now, what I'm unsure of here is whether there are two scenarios. One is that we are still in a bull market uptrend, and when that happens, you tend to get 3 waves to the downside, or you tend to get 3 waves against the prevailing direction, and then 5 waves in the direction of the main trend. Now, I'm not a strong Elliott wave advocate. I just look at it as one of many tools that I use, and I only use it in the broad sense. But that is a pattern of crowd behaviour that does tend to play out. So scenario 1 is that we are still in a bull market and we've had 3 waves to the downside. This is the A wave here, then the B wave up to the 1st of May. We've completed the C wave, and that pulled up basically at the 38.2% level. Just anchor that side in there. That pulled up at the 38.2% level of the whole run that started in October of last year. So that's one scenario, and we're now poised to start to work our way higher. Now, the indicator that that is the case will be a strong close in the early part of next week above probably 1325. I think if it does close up there and does it strongly, then I think we're probably going to head back into the 1400s again. The other scenario is that we have topped out and we're now in a bear market, and in a bear market we would then expect as a first move 5 waves to the downside. So we've completed 3. We're now in a 4th wave to the upside that is still in progress, with still a 5th wave to the downside to come, with possible targets down around 1250 or possibly even 1200. So I don't know which one of those two scenarios is the prevailing one at the moment. I suspect that we're more likely to be in the former. In other words, we're still in a bull market, and that we may see that we've seen the lows at 1290 and that we'll see progressively higher prices over time. However, the second scenario is possible. Now let's have a look at the currency markets, and this is the US dollar index. You can see we had a double top up here at 81.5. It clearly broke through there on Thursday and Friday of last week. We've got next levels up 83.5, and then you've got to go to almost 89. So you can see quite a strong close, 3 days in a row to the upside. So that's obviously putting pressure on commodities, which is putting pressure on the Australian dollar, which is obviously putting pressure on a whole range of our stocks. So that's going to continue, I think, until there is some kind of announcement or some kind of stimulation happening in Europe, because the euro is going to continue to slide, which means the US dollar is going to continue to go up. Let's have a look at the main Australian index. This is the ASX 200, and you can see, other than 2 days up in the early part of last week, pretty ugly, and you've got to say that we're probably going to dip down under 4,000 in the next couple of days. Now, the index is oversold, and so you could expect a bit of a bounce, but it's really hard to see where that bounce is going to come from at the moment. Let's just have a look at the financial index, and we'll put this on a weekly chart. So you can see it's lost quite a bit of ground, lost nearly 400 points in the last 3 weeks, but really still has just been in this very, very large trading range. And let's have a look at the materials. Materials lost more ground again in the last 2 to 3 weeks, have really dropped out of that trading range they're in, and clearly trending to the downside at the moment. But you'd have to think that the majors can't be that far away from some sort of basing pattern. Okay, let's have a look now at some of the other indicators. Bond yields, Spanish bond yields on the 10-year did push up a little bit higher, which is a concern, 6.31 compared to last week, but the Italian 10-year yield did decline a little bit. So it's not disaster territory, but it's certainly not great, particularly for Spain. Central bank intervention is still anticipated, and that's why I think some of the credit spreads are still relatively mild at this stage. And the US dollar, as we saw, clear breakout above a double top and heading to those higher levels. Now, gold fell $20 an ounce on the week, dipped below 1550 again, but again recovered, so still looking reasonably resilient at this stage. But what we did see, which was fantastic, was the really good follow through on the Huey index, which is the main gold index that's watched in the States. It had been struggling. We saw a big reversal the week before, or what looked like a big reversal. We needed confirmation, and we certainly got that. It was a strong week to the upside on the Huey index, and we saw the GDX and also GDXJ indices also recording pretty strong gains. Oil fell slightly on the week. Brent crude was down, and light sweet crude was down a little bit as well. Copper, however, finished $3.48, so only down just a fraction, which was pretty good considering the US dollar rose as much as it did. Copper, obviously, and other commodities heavily dependent on the US dollar direction in the short term, but the copper really holding up quite well, I think. And this is it on a weekly chart. So it hasn't really come off all that much when you consider what the market has thrown at us in the last 3 to 4 weeks. It's come down from around $3.85. We're now basically $3.50. That's not that much. And we did have comments through the week from the head of BHP saying that he believed that the copper market would be in undersupply for the foreseeable future. So from a supply-demand point of view, that's a pretty strong endorsement for copper. So let's have a look at some of those, the gold charts. First of all, we'll look on a daily. As you can see, it was really a pretty up and down week. Sold off a bit on Wednesday, but did recover. And if we look at this on a weekly chart, you can see that this 1550 level is holding. We're getting the odd dip underneath it. But even on a weekly chart, this is quite oversold. So I'm really hoping that we can see a bounce back maybe to around the 1700 level. May still continue to go sideways for a few more months yet, because we've got to remember that it was 34 months to the upside. Not unusual to get quite an extended consolidation. The consolidation started in September of last year, anywhere between 6 and 12 months. Is not abnormal after a very, very strong run of 34 months on whether it's gold or whether it's a stock. If you see a 3-year run that ends in a significant blow-off to the upside, you can see how rapidly the price rose above the moving averages and above the trend line. 6 to 12 months of consolidation, absolutely normal. So we've got to keep the movement in gold in perspective. Let's have a look at the Huey index. So this is on a weekly chart. If we pan back, you can see we had fairly important support down here at 370, 372, and we got a good reversal last week off that support and excellent follow through. Now it's not assured this is going to continue up, because you can see we had a really strong week back here in January, we had another strong week back in October. So it's only the first step, but nevertheless it's great to see that follow through to the upside, particularly on a week when gold went down. Okay, so just to finalise in terms of overall strategy, the S&P index, 1290, 1322 are the key levels to watch. Some of the reasons that I still favour the bullish case, or I don't favour the bearish case, is that investor sentiment is still extremely bearish, and you don't tend to get tops when sentiment is as poor as it is at the moment. You tend to be closer to bottoms than anything else. We're also seeing the credit spreads in Europe basically not increasing very much, and certainly not nowhere near the levels that we saw in 2008. We've got the VIX index. We'll just have a look at the VIX index. VIX index, you can see it's still only basically around 21. This is not the sort of area where people are obviously panicking and looking for insurance. You can see the market upheaval we had last year in 2011. We were up above 30 for quite a few months, got up as high as 50. The fact that we're now down at 21 just indicates the absence of fear in the market at the moment. So for those reasons, I believe that the bullish case is still the more valid one, but I am certainly open to the fact that we could have more downside, and especially in the Australian market, which is underperforming quite a lot. So the key levels to watch are 1290 and 1322. I mentioned last week to expect a relief rally. We got that. Where we go from here is really a little bit unclear. We'll just have to wait and see and be guided by the market. When it comes to Aussie stocks, I believe you should remain biased to the short side. If you're not into shorting, then you probably shouldn't be doing very much at all, because I think that's still where the bias is. But obviously you don't want to short sell any old stock. It's a matter of getting the stocks right and also getting the entries right. There are some good buying opportunities setting up, but obviously need a fair amount of care. And there's some small caps, good quality small caps, that are certainly down into some good buying zones. But I'd only be looking for a bounce only. I wouldn't be looking necessarily to buy them for the longer term. So that's it for this week, and we'll have to wait and see what the market delivers. But talk to you again next weekend. Cheers.